Today we speak about saving strategies for retirement. Retirement is considered an age in which you take rest from a regular job, providing you with income flows that are predictable and that is inflation adjusted, either through periodic salary increases or through dearness allowance, which takes into account the rise of prices and rise of cost of living. We are not speaking of people who are trying to retire at the age of 35 or 40 when they have built sufficient amount of corpus and because of their internal calling, they try to get out of active life and pursue a life of their choice. There are 4 or 5 things that are required to be done in order that the corpus that you have accumulated at the time of retirement could last you for a lifetime. At the current living standards and at the current life expectancy at the age of 60, a good medical care system will enable people to live up to the age of 85 or 90 years. So how do you invest your money at time of retirement to last these 25 or 30 years? There are 2 components to it. One, a regular income that could come at the current projected rate of return from the class of investments you are recommended to invest. I am providing you information based on my reading and my observation of people who have succeeded in doing well in their investments and maintaining their lifestyle post-retirement. You can consult your own investment consultant. The first important one is to determine upfront what is your drawings. If part of your drawings for living in the next 25 to 30 years is covered by a pension or by an inflation adjusted pension, better still, then to that extent you are safe. And it is always recommended that some of the inflation adjusted income components form part of your investment strategy. Investments today are mostly made into 4 categories: the stock markets, either direct investment or through mutual funds, to real estate, gold, and of course to fixed income instruments. 3 assumptions: the bank will continue to return you on long-term deposit over 6% in the longer run. The stock markets will, based on the past performance, is likely to return over 10%. The gold is likely to appreciate over 6.5% over a long period of time. So what you need to do is please restrict your withdrawals wherever possible to around 5% so that your income stream through interest and capital appreciation and periodic rotation of your turnover will match your withdrawals. Many people, when they get older or when they attain the retirement age, they say that we do not have the appetite for taking risk in the stock market. The current recommendation is that 30% of the total corpus, even if you are older than 60, should go towards equity, and you can always have a conservative approach to stock market by either investing in an index fund or a mutual fund with large value stocks, what we call blue chips, or longer term investment strategies where you read fundamentals and take position in those companies where the debt is less, cash flow is high, and where the industry outlook is good. Second important thing is that keeping enough money for your liquidity or emergency requirement. One of the strategies that is recommended is 12-20-80. 12 months expenditure is put in liquid or short-term funds, 20 in gold because gold is supposed to provide stability, and 80 in other instrument including equity. Now if you want to put short-term investments, the bank savings bank deposits are providing very low rate of return. Some of the highly rated government security bonds which are highly liquid in the market, and some of the mutual fund instrument which provide corporate debt as their backup security are good investment because they provide 1 to 1.5% more than plain vanilla savings bank account, and you can always divest it or you can stay liquid with. Third important thing, that take full advantage of government schemes like Bhai Bandhana Yojana, like the senior citizens saving scheme, where although there is a cap of about 15 lakhs or so in how much you can deposit, because they provide 7.5% kind of return, it is better to take full advantage of house rent, one inflation adjusted kind of an income. If you can invest part of your retirement corpus into a home, or second home rather, which can provide a regular stream of income, it could be good. The whole idea is not to assume large amount of risk. Keep your withdrawals to a level where, based on various scenario analysis, is likely to last between 30 to 35 years in the least, including the principal withdrawal and the interest withdrawal. And wherever possible, if you are recycling part of your income, then it perpetuates the income stream to that extent. Last but not the least, churning of your portfolio, especially the equity portfolio, after 5 or 7 years is important, because the repositioning of the portfolio is necessary in order to maintain its durability and sustainability. So keep equity in focus. Make short-term investments, being aware about risk, especially those schemes which are providing a little higher return as compared to savings bank. Put a part of the investment in gold, government-backed deposit schemes for senior citizens. Keep your retirement corpus intact and lasting for the life when you are away from a regular income and inflation-adjusted income. Thank you very much.